Let us now look at Article 25, Paragraph 1 of the India-USA Treaty, and this deals with credit by United States of America. Now, for the purpose of our discussion, we are going to assume that United States of America is the state of residence. In accordance with the provisions and subject to the limitations of the law of the United States, as it may be amended from time to time without changing the general principle hereof. The United States shall allow to a resident or a citizen of the United States as credit against the United States tax on income A, B, and then there's a following paragraph. But let us first concentrate to this particular part over here. What this part says is that the United States shall allow to a resident or a citizen of US. So the eligibility is based on two criteria. Either the person is a resident or a citizen of United States. If he is a resident or a citizen, then he shall be eligible for credit against what? Against the United States tax. So it becomes important to understand what exactly does United States tax means, right? But the credit which shall be available to a resident or a citizen, as the case may be, will be in accordance with the provisions and the limitations of the local laws of United States. What this means is that if under the provisions of the domestic law of US, there are certain conditions to claim a credit, those conditions will be applicable. If there are limitations on the quantum of credit, those limitations will be applicable. Subject to those provisions and limitations, a US resident or a citizen shall be entitled to the credit against the US taxes on his income of what? Of A, the income tax paid to India by or on behalf of such a citizen or resident. So first thing is, taxes should not be due, they should be paid to India, right? And these taxes can be paid by the resident or the citizen directly, which is covered in this word, or even if there is a withholding tax or TDS as you call it, which is applied by the payer and he deposits the taxes to the Indian government on behalf of the non-resident, even for those taxes, he shall be eligible for credit against his US taxes. And second, so this provision is applicable to all, right? But there's an exception to this, or an additional benefit, if I may call it, not an exception, an additional benefit. In the case of United States company owning at least 10% of the voting stock. So if there is a US company and there is an Indian company, right? In case of a US company, when we talk about US entity, it has to be a company only. Non-company are not covered. Owning at least 10%. So if this company is owning at least 10% of the voting stock, not the preference shares, of the voting stock of a company, which is a resident of India and from which the US company receives a dividend. So if this company is a resident of India and this company gives dividend to the United States company, right? The income tax paid to India by or on behalf of the distributing company, which is the Indian company, with respect to the profits out of which the dividends are paid. So if this Indian company declares a dividend and dividend is declared out of certain profits on which it pays a corporate tax, right? if the dividend is received by a US company which is owning at least 10% of the voting stock in this company, then the US company shall also be entitled to the proportionate credit for the taxes paid by the Indian company. For the purpose of this paragraph, the taxes referred to in paragraph 1b and 2 of Article 2 shall be considered as income taxes. Now, it is only for the purpose of this paragraph. Please note this word. The definition of taxes as referred to in paragraph 1b and 2 of Article 2, taxes covered, shall be considered as taxes for the purpose of this paragraph, which means even for certain other provisions of paragraph 2 or 3 of Article 25, the definition referred to in Article 2 may not apply. Let's look at the key features of Article 25, paragraph 1. Credit shall be in accordance with and subject to the laws of the United States. Credit is available to a resident or a citizen of the United States. Credit shall be available against the United States tax, which is referred to in Article 2, paragraph 1b and 2. And credit shall be available for income tax paid to India by or on behalf of such person. By means directly, on behalf of, maybe by way of TDS. The underlying credit is also available in respect of the taxes which would have been paid on the profits out of which such dividends are declared, provided 10% of voting stock of the Indian company is owned by the US company. For this underlying credit, please note that if there's a US partnership firm or an individual, right, which is owning maybe at least 10% of an ICO, they shall not be entitled to the benefit which is given to for underlying credit. It is only a company which owns 10% or more in an Indian company that is entitled to the benefit of such underlying credit.